Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. Today I have with me Jacob Vanderslice with VanWest Partners. How you doing, Jacob?
Good morning, Lance. Thanks for having us.
Yeah, no, my pleasure, man. Yeah, so I've known Jacob and the crew for years now. Worked with those guys back, was it probably 6 years ago? Maybe longer. I mean, time just flies. So I've known them a long time. They've been clients of ours. We administer their funds on the VanWest side, and they're a VanWest Gold member. So, my day job over at VanWest, we're actively involved with what these guys are doing. So happy to have Jacob on. He's a busy man. We've been trying to get him on the show for quite some time. Their primary strategy is acquiring self-storage. Self-storage is, kind of a booming property type people have been, getting into for reasons I think Jacob will share with you here shortly. But these guys have kind of found a niche and built a brand and done some really interesting things in the space that I think all of you will find interesting. But before we get there, Jacob, why don't you share with us kind of your real estate journey? How did you get into real estate investing? I know you've, you were big on the single family side, and you've done a lot of stuff. You've been a real estate guy for a really long time. So what attracted you to it initially, and maybe just kind of walk us through your journey that led to you and the guys forming VanWest Partners, and really and that kind of should get us right into the current strategy you're executing.
Yeah, well, I'm proud to say that I've been unemployed for 15 years now. My last job, I was a career firefighter. And I started doing fix and flips on my days off and kind of scaled it up from there and got busy with those and quit my fire job and got full-time in real estate back in about 2006. And had a lot of hard lessons out of the gates. Obviously, there was a terrible time to get in. I was in my early 20s, didn't have any financial training whatsoever, couldn't underwrite a deal, couldn't do a spreadsheet. I can still barely do a spreadsheet. That's why I have partners. And kind of rode the wave through the downturn and then the upswing as well. So cut our teeth in single family. We've done well over 1,000 single family residential deals over the years, a lot of rentals, a lot of buy, fix, and sell. It's a fun business. We enjoy it. We hardly do much of it anymore just because deal flow is so tight and it's very transactional. And then back in 13 and 14, we got into commercial real estate. We started doing adaptive reuse retail, which is basically converting old warehouses around Denver into multi-tenant experience-based retail concepts like breweries, restaurants, yoga studios. We held on to some of those and sold off others. In between all that, we've done a fair amount of townhome development, just ground up for sale, residential townhome development. Did a little project about 6 months ago that we sold out of. And then we got into self-storage in 14 and 15. And we like the asset class because it's been historically resistant to downturns. And back in 15, we really thought a downturn must be around the corner, and we were wrong. And we even thought that early 2020 was going to kick off a major downturn. And obviously the economy was wrecked, but a lot of real estate sectors were not beat up much, and if anything, they got better. We've been in the business now for about 6 years. We started off with ground up development projects around Denver as a co-GP with some high net worth investors, also backed by a life insurance company that did a lot of the debt and the equity. So we did a few deals in Denver. From a ground up perspective, we repositioned another deal from office into self-storage, and then we expanded the program into the Midwest, into Milwaukee back in about 16, got a number of deals out there. And then we kind of kept going. We launched our first fund. We've historically done single asset syndications in the storage space and the commercial space. We did our first fund in mid-19 in self-storage. We closed that out in August of 2020. Then we launched a new fund in January of this year, and that fund is underway. We're about halfway through our capital deployment target. And as of today, we own 30 self-storage facilities, roughly about $155 million in total capitalization. And these days, we're mainly focused less so on development and more so on buying existing properties that we can add value to with management efficiencies.
Yeah, and you also, along with that, didn't you guys develop sort of an operating platform? Because oftentimes, it's important to understand that self-storage it acts a lot. I mean, like small business. It's like it's each little thing's its own business, and obviously it's very real estate dependent. But you guys developed your own sort of brand. I mean, a lot of guys build stuff and they go and hire the big boys like Public Storage or CubeSmart or things like that. So maybe it's kind of a segue into what you guys have done. Maybe give us some color on why you decided to do that. What it's called, why you did it. Just kind of those mechanics that go into running, not just acquiring self-storage, but just how one operates it.
Yeah, self-storage, as you touched on, is very operationally intensive. There's a lot of misconceptions out there that it's kind of fire and forget, and that couldn't be further from the truth. It's very customer service based. They're all month-to-month leases. It seems like a stretch, but I would liken it, and this isn't me making this up, I've heard this from others and I agree with it, that it's very similar to hospitality to a degree, and that your rates are constantly changing. There's a seasonality component. All the leases are short-term. They're not one-night leases like hospitality, but they're month-to-month. People are constantly moving in and moving out, and the revenue management's very dynamic. So when we got started, we initially outsourced our portfolio to the big institutional players, and we were dazzled with their algorithms, with their call center, with their online marketing, and just all the data they have access to. And as the months kind of fall off the calendar and the honeymoon was over, we started to realize that to a degree, third parties' interests were misaligned with ours. There are a lot of revenue streams in self-storage, like other asset classes, that go far above and beyond rent. And in some cases, we weren't participating in those revenue streams, and our third-party managers were. Another issue we had, too, were on the operating expense side, specifically marketing. So marketing allocations in a self-storage facility, when you play with the national REITs, are basically calculated on some kind of algorithm that we can't understand. So, for example, we'll be spending $30,000 a year in marketing on a given property, but they can't exactly attribute those marketing dollars to driving traffic to our location. So that was kind of a source of frustration. And then little things like snow removal, for example. We had a facility with a very small parking lot, and then a facility with a very big parking lot, and they were very different in size. And our third-party operator gave us a budget for snow removal that was the same. And little things like that were kind of frustrating over time. And really the key to value creation, at least in our strategy, is on the operations side and controlling expenses and growing NOI. And because of that, we formed our own management platform, which is called Clear Home Self Storage, about 3.5 years ago. And we took on a few of our facilities initially, then kind of slowly kept acquiring more, putting them under our brand. And then in one of our partnerships, we recently got rid of one of the national REITs, and Clear Home took over a $40 million portfolio for just that exact reason: expense controls, transparency, kind of a human touch on the revenue side versus just putting it through a computer and hoping for the best. But it's a painful business. Management in anything is a painful business. We have homeless issues in our urban infill locations. We have customer service issues here and there. Maybe a gate control goes down, someone's upset. So our call center is always busy. We're always trying to make customers happy. 5-star reviews are important. But in the end, we found that we can control our expenses and control our revenue a lot better than third parties that are big can. And primarily, we just care more. We care a lot about our deals. And inherently, just human nature, a third party maybe doesn't care as much as you do.
Yeah. And so for you, it sounds like now with the Clear Home, you're doing the management for other people's properties as well, not just your own?
So we are not doing any third-party management yet. That's probably not in the business plan anytime soon. It's certainly a consideration down the road, but we are only self-managing properties that we own.
Got it. And then in terms of I'm always curious as to when you develop those sorts of brands then in that operational capacity, how does one separate the enterprise value of that? I mean, do you still treat it where now you've got the entity that owns the asset? I mean, you guys use a fund obviously to finance most of the equity side of the deals, but how do you keep those things separate? Now Clear Home is charging a management fee to the property owner LLC, and then mean, could you in theory, create enterprise value with the operating platform that could be sold separate and apart from the transactions?
In theory, you could, and being a real estate entrepreneur over the years, we've always kind of lamented that the value of our company is basically in our asset base. Our company, VanWest itself, doesn't really have, or historically hasn't really had, any enterprise value. So we're not going to go sell VanWest without its assets to somebody for some sort of EBITDA multiple. But in the self-storage management platform, we're starting to create what we believe is some meaningful enterprise value, and that's going to take a long time before it's actually there. But as far as structure goes, ClearHome is wholly owned by myself and my two partners, the principals of VanWest. ClearHome has a management contract with every property that we own with the entity that owns the property. And our management fee to ClearHome is 5% of monthly gross receipts. And every other piece of the revenue stream in self-storage, obviously base rent, late fees, tenant insurance, which you can expand on if you'd like to, late fees, all of those flow through to the entity level, then to the fund level, and then to investors.
Yeah, so it seems that it's important for investors to sort of really, when you're looking at a self-storage deal on its face, really sussing out those things, seems to be important, right? Because knowing where those revenues are going and who's being paid what is super important. And as you said, you guys as operators realize that some of these third-party management firms, you couldn't figure out, these proprietary algorithms are coming up with crazy stuff that you don't control. You sign their agreement that allows them to do that. It seems to me it's a bit, me, I'm like the transparency guy. It just seems a hell of a lot more transparent, kind of, with what you guys are doing.
Yeah, we can point to our marketing dollars driving lead traffic to specific facilities, and a lot of folks have told me over the years that if you hire a national REIT and you're paying them a 6% management fee, you're not really paying 6%. You're paying a lot more.
Yeah, and we've run into that on the monitoring side, is doing the ongoing monitoring for some of these self-storage deals that have one of the big guys. We're trying to follow that management agreement, property management agreement, and figure out how in the world they calculated their fee, and it just never ties out. Like, so every month it's sort of like, yeah, here's an anomaly. The anomaly is we have no idea, and they go back to them. Of course, I think it's probably your same experience that led to forming your own platform. It's just that, it's sort of like they don't have an answer. So I think that's the big piece of it. How did you guys then handle too, just on the getting up to speed on the marketing side? Because it is pretty competitive. So now you're sort of competing with some of them, or product, and most of them have product probably in the markets you guys are operating in. How do you get traffic, and how do you compete with them, who have these really sophisticated revenue management systems and dynamic pricing and all that kind of stuff? Is there a way that your strategy sort of flies under that radar, or
Yeah, to a degree.
How do you compete with them?
Our main competition with the national REITs is on the acquisition side and the deal flow side. It's not so much on the operation side. Self-storage is to a degree a commodity. People want price, and they want it to be clean, safe, and secure. We run pay-per-click advertising. We obviously have a website. I think over 75% of our customers find us online. We try to focus in markets that have relatively low supply ratios and relatively low risk, both objective and subjective, of new product being introduced to the submarket. We've seen some markets, specifically in Denver, like Denver Tech Center, it's southeast of downtown Denver. A lot of new product got delivered there at the same time, and rents went down by over 50%, and occupancy struggled. So we try to monitor that. As far as secret sauce goes, there's not a ton of secret sauce in self-storage. The only thing that we have that I would liken to kind of a proprietary platform, one of my partners, Aaron Westfall, is a software engineer by training, and he built some self-storage analytics software that's kind of like the MLS of self-storage. So the software goes out and scrapes all of the face rates from all of the national operators and some of the regional ones as well. And so, for example, you could draw a box around downtown Denver, and if you want to know what an elevator access 10 by 10 climate controlled unit is leasing for, it'll give you all that data. So that helps us with our underwriting as well as our revenue management. And as I mentioned earlier, self-storage is very seasonal. peaks and troughs in the winter and summer, depending on where you are. So the software also has tracked and cached away all of these historic rental rates for the last 4 or 5 years. So we have millions of data points across the country. So we can look at historic revenue on a given submarket and look at the peaks and troughs, not only between the winter and the summer, but also like when an event happens. For example, the Florida Panhandle, Hurricane Sally came through last hurricane season. There was a big spike in asking rates for self-storage because obviously people's houses are flooded. They need places to keep their stuff. But if you're underwriting to that snapshot in time, maybe you're out of town, you're buying a deal in Florida, you're looking at in-place rates in that submarket, and you're not interpolating for that, you can make a poor acquisition decision and probably pay too much. So we've got that in our back pocket on the underwriting side and the revenue management side. We also have a lot of human touch in our revenue management. We'll look on a weekly basis what our unit mix is doing on a given facility. And for example, if 10 by 10s are really full, maybe 95%, we'll increase rates with 30-day notice on our 10 by 10s. And if 5 by 5s on the other side of the coin are dropping in occupancy, we'll drop rates there, drive up occupancy to kind of critical mass, and then start increasing rates over time.
Yeah. No, so that does seem, yeah. I mean, that's the kind of data that, having that, has it also allowed you to choose like which markets to go into? I mean, you guys are headquartered in Denver, but you're making acquisitions all over the place, right?
Yeah, so we haven't bought a storage deal in Denver for years. Denver's fairly oversupplied. Rates are compressed. It's tough market to find yield in. So we're mainly focused in the Midwest and the Southeast. And we're trying to find submarkets and deals that have a good blend of current dividend yield with capital appreciation and upside on reversion as well. And finding deals that do just cash flow and not appreciation, or just appreciation and not cash flow, is a little bit easier than finding deals that do both. So that software component certainly helps our underwriting and on our submarket selection as well.
And then who are you typically buying from? Like, are you targeting sort of more of the mom and pop, type of people? Is that part of the strategy, or at this point you don't care who owns it? It's sort of the data's driving, like you said, you're looking for income and appreciation sorts of deals as the filter? Yeah,
it's mostly less than sophisticated ownership groups. I think over 70% of storage facilities in the U.S. are owned by people who own 1 or 2 properties. Maybe it's an airline pilot who bought one just to kind of run in his time off, and maybe a family kind of fell into it. They had some farmland. They built a storage facility 15 or 20 years ago, and they just own it and enjoy the income stream. So most of the groups are not large or sophisticated self-storage operators. And there's really 2 types of deals that we're focusing on. There's deals with lower occupancy. We won't buy below 50%. But let's say we buy a deal at 55% occupancy. Our year 1 business plan there is primarily occupancy growth. And let's say we buy a property at 95%. If your storage facility is at 95%, you're not a hero because your rates are probably too low. Ideal occupancy in self-storage is low 90s, maybe high 80s. You want some turnover because it's an opportunity to raise rents. It's an opportunity to get a one-time move-in fee from your customer base, sell your customer insurance plans. And the primary focus on those deals in year 1 is getting below market customers up to market rates. So those are really the 2 types of deals we're focused on: lease up, value add, and then just mainly value add from an operations perspective.
So on the second one, how does one go about that when they sign these are month to month deals? So you can raise rent when you want to, or how do you control that when there's high occupancy and they're paying what you believe is sort of below market? How are most of those agreements written? How do you?
They're all month-to-month leases. We'll typically come in. We won't do rate increases immediately. We'll typically do some capital improvements, like upgrade the camera system, gate systems, maybe seal coat the asphalt, repaint the doors. Sometimes we'll do a little more than that, but just depends on the deal. So we can increase rates with a 30-day notice to our customer base, and we don't do it on all of them, but we'll select certain unit types with stickier customers who have been there for a while. And if a guy's paying $100 a month and you increase his rate by $10 and he's been there for 3 or 4 years, chances are he's not going to move, and you can justify the rate increase with the improvements in the property. Self-storage is a fairly sticky customer base. Even though they're month-to-month leases, most of our customers stay in their unit for longer than they expect. Our average duration of tenancy within our fund is about 16 months. And frankly, by the time you pay 16 months of rent, you probably could have bought new stuff, depending on what you're storing there. And we're buying an acquisition in North Carolina in about a week. And the average customer duration of tenancy in those facilities is 4.5 years, which is astounding. So most of our customer base can withstand that rate increase. And as a percentage of their existing rent, it's not much. And in gross dollars, it's not much either. But when you amortize that across 1,000 units or more, it's not only a substantial increase to your dividend yield, but it's also a substantial increase to your total value creation. 10 grand times 1,000 with a 7 cap is, you've created a lot of value in the property.
Yep. So what do you see maybe other, a lot of people have jumped into self-storage lately, and that sort of tells me typically that means it's amateur hour. And I do think a lot of even the development that was done, you talked about Denver, Portland has the same problem. People just, self-storage is awesome, and they just started building it everywhere. And now we've got enough supply for, I don't know, a long time. So what are the mistakes or the things that you guys observe being so active that are sort of those rookie mistakes or, the amateur moves, the things to sort of not do, what are the things that people are doing that you're like, oh boy, that's terrifying that people are.
Yeah, I'll first talk about the mistakes we've made, because we've learned so much from our failures and not much from our successes. Sometimes successes feel like you got lucky, maybe you did a good job, but all boats have been floating for a number of years. So one of the things we screwed up early on is assuming that we could operate self-storage facilities completely remotely. And a lot of guys do that. Red Dot's a good example. They've got a pretty good platform with a big portfolio that's not staffed. But you still need that customer service component, and you need somebody on the ground when there's an issue with someone versus just calling a call center. So early on, we did a few facilities that were completely remotely managed, and R&M suffered, the quality of the facility suffered. We've corrected that since. And so now our management platform, we have facilities that are unmanned, but with a regional manager within a couple miles of it who goes by and does quality control checks. They're on W-2. We have facilities that are staffed part-time in the leasing office, not 40 hours a week, but maybe 25 or 30. Customers can still move in online, make their payment online, but if they want to talk to a person and walk in the office, they can. And then we have our traditional management platform, which most self-storage has, with the full-time leasing representative in the office. They can go tour units with you. So that's one mistake we made, is just the staffing component early on. As far as what we're seeing other folks do, the model will tell you whatever you want it to, right? We saw a pitch deck from a sponsor with a bunch of deals in the southern United States, and there were a couple things that jumped out. One of the things that jumped out in the cash flow modeling was the sum of their fees, and you had to kind of infer this by doing the math in the cash flow model, was about 14% per year, which is a lot off the top. I mean, that's a material detriment to investors' interests. The other issue we saw too, that we see this mistake being made often, especially by brokers and their OMs when they're taking a property to market, is not properly accruing for property tax increases. As I'm sure you know, self-storage leases are full service month to month. The tenants aren't paying for anything other than their base rent and tenant insurance if they want it. So if you're not underwriting a property tax increase correctly, that can be a material change to your dividend yield. Same with multifamily, obviously, too. So we see a lot of tax accruals that are getting missed or miscalculated. And a lot of people are just hoping to get a deal done that property taxes aren't going to go up. We're going to keep them static. And if the assessor catches your increased value and your increased strike price, you're going to have a problem. And another thing that we're seeing, again, the model tells you whatever you want it to, is folks are underwriting to what we think are fairly low cap rates within 3 to 5 years. We try to be very conservative in our cap rate forecasting years down the road. Now, we know we're going to be wrong no matter what. We're going to be wrong in the right direction or wrong in the wrong direction, but whatever we think we're going to sell it for, we're going to be off. We see quite a few pitch decks come through that are forecasting 6 cap exits on probably C+ locations and C+ asset quality. in 3 to 5 years. And if you raise that cap rate assumption to maybe 7%, it's a material delta in your total equity multiple and total IRR. So egregious fees are something we see often, property tax accruals where folks are just kind of lying to themselves, and then what we believe are kind of less than conservative exit cap assumptions years down the road. So we're seeing a lot of that right now.
Yeah, and I think that that's a bit of the issue, right? Is that because investors then they really hone in on those projected net IRRs and equity multiples, and sort of don't pick up on the fact that that's just fiction. And for those of us who do, you operate a spreadsheet. I mean, you changed the exit cap by, 10 basis points. I mean, it moves the number. I mean, it's very, very sensitive, and I don't think that people fully appreciate that. And most people, you go and look at it, it's always like round numbers. It's like 6.5, 7, and I'm going, yeah, but the 50 basis points in between there, it really does create a lot of fluctuation. As you said, you're guessing, and so those are the things that make it difficult. But of course, people are attracted to higher numbers, And I think it seems to me too, even looking at, maybe you can speak to this, Jacob, is sort of you see a lot of sort of self-storage development deals that pop up, but people that aren't developers, they don't have a background in doing development, but yet they somehow found a piece of land that they're going to erect some self-storage on, and it seems to me that, I don't know, it just seems way more risky than people realize. And I know you guys have done some development. Maybe you just speak to self-storage development, and it's not as easy as people think it is, even to turn up and self-storage units, right?
Yeah, development in and of itself is risky. The reward is certainly there, or could be there. But I mean, the main risk, first of all, depending on the city you're building in, you're going to have probably a 2-year runway from land acquisition to delivery of your self-storage facility. That's a lot of carry. That's a lot of interest carry. You're carrying taxes. So you have to kind of bake that negative cash flow into your sources and uses and make sure you're capitalized for that. The second risk to development is you're forecasting rates out years down the road. And your first lease is going to be signed when you deliver that property in 2 years, but you might not reach stabilization for another 3, depending on the leasing velocity. So we see a lot of pro formas call for 12 to 18 month stabilization. That's pretty tight. It should be a lot longer than that. But you've got the hard cost risk, of course, and that's any development project, right? Steel's to the roof. Lumber has been historically through the roof. I think it's calming down lately, but that's been a big risk. But you're just forecasting out rates years down the road. And if you think you're going to get $1.50 a foot at stabilization in 4 years and you get $1.10, that's a material delta, obviously. So I think there's a time and a place for development, and I think we're seeing some new development opportunities that are arising that we weren't seeing recently. We're not necessarily targeting those, but we are only focused on existing value add. So frankly, if we miss our numbers, we still have income. And we can still pay our mortgage, and we can still make distributions to investors. Development works, but it comes with a risky price tag, obviously.
Yeah, that's right. And then obviously you saw, I mean, these magic numbers. How do you guys value? Look at it again. Is that the number? What's the magic number for self storage? How many per? There's like some magic number.
Yeah, nationally, self storage supply is about 7 square feet per capita, maybe 8. And if you're getting over 10 or 12, you're starting to see a little bit of saturation and a decline in rates and occupancy, and then under 7 is a little more stable. But there are markets where a submarket might have a high supply ratio, maybe 15 square feet per capita, but the facility that you're buying has been at 95% for 3 years. And there's low risk of new supply because you're buying it at a below replacement cost price. So you can't always say that you're not going to buy a deal in a market with 15 square feet per capita. You could buy that deal and hit a home run, and you could develop in a submarket with 5 square feet per capita and still have a problem down the road. So you can't just kind of you can't just kind of call supply ratios the end all be all to an acquisition decision. There's a lot of interpolation and other data points you have to consider. But that's one of the risks for sure is oversupply. And we've seen that, like you pointed out, in Portland. Seattle's a good example. Denver's a good example. So is Miami. Just a lot of folks had the same idea at the same time, came out of the ground, and it was a race to the bottom on rates.
Yeah. So in terms of like are there certain markets right now that you're more bullish on, or just areas you talked about, the Carolinas, or
Yeah.
I mean, is that one of your things that you look at? It's just we've kind of got this great reshuffle taking place with people sort of moving all around the place. Are there certain places that you guys are kind of like, hey, Tennessee or the Carolinas or Boise? I mean, I have no idea.
Boise's been a hot topic for everybody lately. One of our partners is doing a bunch of multifamily up there. You hear about it all the time. We haven't looked at storage up there aggressively yet. But the markets we like in general are the Midwest and the Southeast. North Carolina has been a great market for us. Florida Panhandle has been really good too. Obviously, Milwaukee's been good. In areas we're not going, we're shying away from markets with declining populations like New York, for example. California, which is becoming less and less of a business-friendly state for lots of reasons. We're not targeting deals out there necessarily. We just like good nuts and bolts real estate fundamentals, good demographics, good incomes, a story for stable employment bases. We are fairly geographically agnostic overall. There's not really anywhere specifically we won't go other than the markets I just described earlier. But we also try to build geographic concentration when we buy a deal. So we've been buying in the Panhandle since early 2019. We have another acquisition that's coming up down there for $18 million in Fort Walton Beach between Pensacola and Panama City. That's been a good market to us. Southeast and Midwest have been areas that we are operating in currently and continue to target.
Yeah. So what is the one thing, like when you guys put in an offer and you win it, like what's like the number one thing that makes that makes you nervous, or the thing that you're like, the thing that keeps you up at night when it comes to these new acquisitions? Is there one thing in particular where you do all the underwriting, but there's always like this thing you're like, man, I hope that this works out how we thought it would? Or what is the big concern for you guys going in that sort of causes you to?
There's a couple things we get concerned with, and it depends on the deal type. One deal, for example, it's a fairly small deal, and sorry, my landline's ringing. It's behind my computer. Hopefully you can't hear it. There's a small deal that we bought as part of Fund 2 in the Florida Panhandle, and we bought it at about 55% occupancy, and it had been at 55% for years. Just mismanaged, bad advertising, bad ownership group. It needs some R&M. Bad website. There's a barking dog in the leasing office with pet stains all over the floor. So when we acquired that one, our year one pro forma was basically very, very nominal occupancy growth, and then kind of taken off on year two. And that's always one thing that's concerning is, okay, this group has operated this for a number of years. They don't do it well, but they've been in the market. They kind of understand the sub-market. What are we going to do differently that they didn't? Mm-hmm. And the obvious ones are customer service, R&M, better website, seamless leasing experience, show that we care about our customer base. But stuff like that is concerning when you go into it, and you got to believe in your ability to execute. That deal's going well. Thankfully, we're ahead of our lease-up schedule. But another thing that concerns me too, returning to our cap rate conversation, is again we're forecasting cap rates out and exit prices 7 years down the road, right? It's an educated guess. It's a conservative guess. And it's a conservative assumption. But number one, what are you going to sell? What cap rate are you going to sell at? And then number two, did your NOI growth get to where you thought it would to execute at that price? So you might still sell at a 7 cap, but if you missed your NOI target by 20%, you're going to sell the deal for a lot less. And then likewise, you could sell it for an 8 cap, but your NOI target went through the roof, and you still attain the same gross dollar sale price that you underwrote. But I guess inferring between all those comments, execution on these deals is a primary risk, and our ability as an operator to effectively control expenses and effectively grow revenue and get to that critical mass occupancy and then keep it there with nominal rent escalations in the following years, Those are all things of concern, and it's not just in self-storage; it's any asset class, right? You're buying the dream. You're putting assumptions into a spreadsheet, and you really have to believe those assumptions are reasonable and achievable, and it's on you as a sponsor to execute on those assumptions.
Yeah, that's a great response, man. Because I do think that that's what people need to realize. And I was having a conversation with an investor the other day, and he's kind of newer to the space, but he's been in corporate finance and adjacent sort of private markets, and that was his biggest observation, was like, I can't believe how few people in this space can't really tell you how they're doing budget versus actual. He's like, it's mind-boggling, right? The fact that like they're so laissez-faire about that side of it, and I'm like, welcome to the Wild Wild West. This is how it is over here. And I think to your point, like that is, people need to realize is that a value add deal, when you hear value add, that means we got some work to do. Like that means that there's like, we're going to have to do some stuff to turn this around. To your example's a great one, right? 55% occupancy, been that way for years. I mean, it's not easy to do it, and that means that when you do put together a pro forma, there is a lot of guessing, and the good sponsors are really as thoughtful as they can be about that. They want to make sure that this seems realistic. And I think that as the passive investor, you need to realize that you need to be doing the same, right? You really need to ask yourself, like, could you really do this? To your point on like a new development, is it really, it's not reasonable to think you could lease this whole thing up in 12, 15, even 18 months. It just, that's a lot of traffic you need to generate. There's tons of units you have to fill up. It takes time, right? And that's just, when you think about it, of course, it makes perfect sense that it's a numbers game. How much traffic is coming in, interested people, what's your close rate? Do you have what they need? Is it near there? What's your competition? And all those things. And so when you're talking to prospective sponsors on prospective deals you might invest in, getting the sponsor to really dig in and share with you how they view what they've put together is critically important. And I think a lot of people skip that step. And of course, most sponsors are hoping and praying to God that you do, right? Because they don't, because oftentimes they haven't done their homework. They're not prepared for that level of, they're not prepared for that test, right? But to get into it, because like you said, you don't know, and now you're trying to move, you're trying to execute according to what you did, but you're going to have to make course corrections along the way with new information you have. And so I think that's what I hope to see in the coming years, is more guys who are as thoughtful as you guys are in that approach, but also surfacing some of the stuff, doing a better job of communicating that as the projects are being executed. I think would make it a much better experience for most investors. Now, that's going to take time, because most people, it takes, they are guessing and they're off a lot. And that's not a conversation they want to be having with people, is, why did you miss the mark by so much? But I mean, that's what it's all about. Like you said, is that it's one thing, you got the exit cap right, but then your NOI is off by 20%. Well, you're not going to hit the value that, you're not going to get what you thought you're going to get. It's just that simple.
Yeah, there's a lot that goes into it. And on the LP and the investor side, a lot of people are so laser focused on IRR. And IRR, I think, is a fairly elusive metric. You can spin deals in certain ways that make them look better or worse by only looking at them through the lens of IRR. So, Lance, if you give me money today and I give you all your principal back plus a tiny bit of profit tomorrow, your IRR is going to be through the roof, but your multiple was very low. Your money's back and you have a tax bill. So a lot of investors just look at it through that lens. And I would encourage people, as they evaluate syndication and fund opportunities and consider participating in the private real estate space, to also look at IRR, but understand how much of that IRR is being delivered during the life of the project and how much of that IRR is predicated on some kind of reversion event, like a refinance or a sale. And I would also encourage them to blend that component with total multiple on their invested capital, as in how much will you make over the entire life of the opportunity as a percentage of your invested capital. I think if all those things are kind of in sync, and not too much of that upside is predicated on an event that is difficult to predict, and there's some income along the way, and the IRR is a market rate IRR and the multiple is healthy. If you can 2x your money in 6 years or do it in 8 years, that's still a good deal. And you can realize that multiple with a big piece of that component being realized along the way. That also helps. So looking at these different opportunities through different lenses is really important, because just looking at them through one, you might make less than an informed decision.
Yeah, that's right. No, this is great stuff. And I think you listen to Jacob here, you can tell that it really is. You treat each property as its own little business. You got to run it. You've got to decide what you're willing to pay for it. You got to decide what's your plan to add value and all those things. And like you said, it's closer to hospitality than people think. These are human beings, and they're renting their stuff, and they're coming in, and there's issues, and it's not a cakewalk, right? And the whole technology, completely unmanned facilities, and all that stuff sounds great. I mean, it's great in a marketing brochure, but it's not that simple, and it really does come down to just certain people are more experienced and more prepared and have a more rounded team. I mean, you look at your guys' team is a great example. You guys complement each other very well, right? Everyone has their role, and those are the things you need to look at. What are all the seats being filled? You've got people that they've got complementary skill sets, how they underwrite deals and assess deals, how they execute their plan, how they communicate, all those sorts of things is what you need to look at here. It's not just like going on, Robinhood and, buying shares of Apple or something. I mean, we're not there yet. I don't know if we'll ever get there. This is, there's a lot more that goes into the real estate side of things. So I think, you guys are great at what you do, and, like I said, very thoughtful and have conviction about how you do what you do as well. So thanks so much for sharing today. Where can people learn more about VanWest and everything you guys got going on?
Feel free to hit me on LinkedIn, Jacob Vanderslice, or go to our website, which is vanwestpartners.com, or email me, jacob@vanwestpartners.com.
Cool. All right, Jacob. Thanks so much, man. You have a great week.
Lance, good to see you. Thanks for having us on.